Hi, I'm David Penn, Editor-in-Chief of TradingMarkets.com. The goal of the swing trader is to take advantage of the fact that stocks never move in a straight line. In a market that's moving up, swing traders catch the big moves, buying stocks after they've pulled back and selling them as they rally into strength. In a market that's moving down, swing traders want to catch the reversal, selling stocks short after they've moved too far too fast and attracted the attention of sellers. And in sideways markets, swing traders do both, taking advantage of range-bound markets to catch big moves and the reversals. Why does this work? The answer to this question is one of the biggest secrets on Wall Street, something that professional traders have known for years. It remains one of the key factors in helping successful traders make money year in and year out swing trading in stocks. The secret is this: pullbacks outperform breakouts in the short term. In other words, stocks tend to move higher after they've pulled back than they do after they've already rallied. Now you might ask, what is a pullback? Well, the short answer is that you can define pullback in any number of ways. You could define a pullback as a stock that has made a short-term low, like a 5-day low. Then you could compare the performance of those stocks 5 days later to stocks that had made short-term highs, like a 5-day high. You could define a pullback as a stock that has made consecutive lower lows. Then you could compare the performance of those stocks 5 days later to stocks that had made consecutive higher highs. You could define a pullback as a stock that has closed lower for multiple days in a row. Then you could compare the performance of those stocks, again 5 days later, to stocks that had closed higher for multiple days in a row. The point is that however you define pullback, the data reveals the same thing. In the short term, the edge is in buying stocks after they've pulled back, not after they've rallied. Now this insight might surprise you. Most traders have been educated to believe that buying strength is good and that buying stocks after they've pulled back is dangerous. But this is why we prefer quantitative analysis and a cold, hard look at the data over stock market myths and folktales. And the data is pretty clear. In the short term, stocks that have pulled back outperform stocks that have rallied. And whether it's called buying the dips or buying weakness, it all comes down to the same thing: buying the selling and selling the buying. Swing trading works because stocks tend to outperform after short-term pullbacks. Power ratings works by providing a straightforward stock rating so that swing traders know instantly when a stock is pulled back to levels from which it has historically made significant short-term gains. Power ratings also warn swing traders when a stock has rallied to a point where, historically speaking, it has tended to underperform. This gives the swing trader plenty of time to take any necessary steps before it's too late. We've got much more to share with you when it comes to swing trading and power ratings, so for more information, be sure to visit TradingMarkets.com today.